Step into the super crowd, where dreams take flight. Learn to invest like a pro, make your future bright. Impact investing, changing the game. Crowdfund the world, it'll never be the same. SuperCrowdHour, come join the ride. Change the world with us, we're on your side. SuperCrowdHour, come join the ride. Change the world with us, we're on your side.
Today with investing in a hey, welcome. We've got a really fascinating topic for you today. We're talking about investing in crowdfund investments, alternative investments with a self-directed IRA account. And you may not have heard of this, and sometimes people refer to this without meaning what I'm talking about today. There's kind of a term of art, a specific thing that relates to this, and it's when you manage your own money and make alternative investments in your own IRA account. And you can't do that at a typical Schwab or IRA or Merrill Lynch account. And so this is really an important topic for those of you who are interested in investing in crowdfund investments, like I talk about all the time, but you want to do it with your IRA. So if you are interested in that, stick around. You don't want to miss 1 minute of this because it's such an important topic. We're going to talk about, the processes, and we're going to talk about whether that will make sense for you. Sometimes the reality is investing in this kind of setup doesn't make sense. And we'll talk to you about why that is for a variety of reasons. I want to recognize my colleague Chandon, who is the producer of the show. He does an amazing job. He runs so much of our work at the Super Crowd. We just couldn't do it without him. Chandon, thank you very, very much. I want to notice we're talking about how to manage your money today. I want to be clear. We're trying to educate you. We're trying to provide information that's helpful. But as you want to execute these strategies, you want to talk to other people to get personal financial advice. That's not what this is. I also want to note that we publish a newsletter, which you may not have subscribed to yet. We send out relevant, helpful information every single day, sometimes more than once a day. We have a weekly digest option. If you want to just get the one email a week from us, that's an option for you. So visit superpowersforgood.com right now and sign up, or just scan the QR code with your phone. Today, this is live. I'm really here, live and taking questions and trying to clear my throat. And we've got, so the deal is, as I'm talking today, you are welcome. In fact, you are encouraged to submit questions for me. So please, if you've got a question, scan this QR code or just visit the short link 4sc.fund/question. That's 4sc.fund/question. And I'll be happy to answer your questions. If you're interested in raising capital from the crowd, and I hope you are, whether you are an active investor, whatever stage of life you're in, we're seeing companies from the tiniest to the giantest using crowdfunding to raise money. And I know you're saying giantest. No, they're not. Newsmax raised $75 million to do an IPO this year. Newsmax, maybe not your favorite news source. I get that. Some people don't like that. I'm not a Newsmax viewer either, I admit. But the fact is, big company, $75 million raise and an IPO this year. It's big companies using this, as well as the smallest mom and pop kinds of businesses trying to build something local in their own communities are raising this. This is powerful stuff for everyone. Check it out. I also have a book, and in fact, today's session comes directly out of my book, How to Make Money with Impact Crowdfunding. If you'd like to get a copy of it, I invite you to do that. Just scan this QR code and you can get a free download there. It's also available exclusively at Amazon if you want to get a printed copy of the book or even listen to the audiobook. You can get an Audible download there at Amazon as well. But grab the free ebook download right here. Following today's live stream, this webinar, we're going to do a private VIP small group discussion. This is limited to the first 10 people who sign up. We'd love to have you. This can really be a helpful way to get your specific situation asked and answered in a way that maybe we would struggle to do during the live stream. Although we're happy to take questions. Already gave you a link for that. The private VIP session may be more helpful to you if you've got real questions about how to implement today's discussion. So I welcome you to join us for that. I also want to invite you to join us for Super Green Live in January. This is a 3-day live stream event. This is going to be amazing. We've got so much great content. We've got great speakers from Siemens and from activists that are climate activists. We've got a whole range of corporate and entrepreneurial and advisory kinds of people. I mean, it's just going to be a whole parade of experts sharing all kinds of great insights into how you can make money helping while you help solve the climate crisis, whether that is as an investor or as an entrepreneur. So this is a can't miss event. Register at supergreenlive.org today. You can register for free and get all the details or upgrade to VIP for the 3-day event for $25. I need to thank our sponsors. We couldn't do this work without them. I'm extremely grateful. Let me just, I'm going to play a little video that gives you a little bit of information about our great sponsors, including Digital Niche Agency. Digital Niche Agency is the top investor acquisition agency. DNA has helped founders raise over 9 figures via regulated investment crowdfunding with a 3-pronged strategy using digital advertising, content marketing, and strategic outreach. You can't argue with success, but you can learn from it. Put the best to work for you. Book a call today. We're grateful for the support we've received from Move the Needle with Rob Kaplan and Ridgecrest Herbals, a certified B Corp. We appreciate our co-hosts.
Prepare to be inspired by Devin Thorpe, a powerhouse in impact journalism and social good advocacy. This best-selling author hosts the acclaimed Superpowers for Good TV show featuring global changemakers like Bill Gates. With a readership of over 2 million, his 500-plus Forbes articles have shaped the dialogue on purpose-driven leadership and crowdfunding innovation. A sought-after speaker from the United Nations to Johnson & Johnson, Devin's unique blend of expertise as a former CFO and investment banker fuels his captivating presentations. Please welcome the dynamic and visionary Devin Thorpe, here to empower us all to harness our superpowers for good.
Fantastic. Well, I'm excited for this discussion today because I think it is so important. A lot of the ordinary investors like me hold most of their financial assets in retirement accounts, which makes so much sense for so many reasons. And it's a great pot of money that it would be great to allocate some of that into crowdfund type investments, these alternative investments. And I, I love making these investments. I've made nearly 100 impact investments via crowdfunding over the last 5 years. And, my portfolio is thriving. I'm really proud of what we've got going. It's a little bit premature to make judgments about those returns, but I'm doing well. It takes a while for equity deals to mature, and so it'll be a while before I know the total returns on a lot of these deals. But I'm very optimistic, and the debt deals I've invested in are doing well. But retirement assets are such an appealing place because we've sort of set that money aside. So today I'm going to talk about how you can do that, because if you call your Schwab broker and say, I've got some money in my IRA and I want to put that into a WeFunder deal this week, you know what he's going to say? Can't do that. You've got to take it out of your IRA. And that'll be the same if you call Merrill Lynch. It'll be the same. It doesn't matter who you call. You're going to get that same kind of answer. You can't do that in a traditional setup for an IRA with a traditional broker-dealer. So we've got to set up what's known as a self-directed IRA. And sometimes I've seen, like, Schwab will describe an offering of theirs as a self-directed IRA because you get to pick your stocks. That's not what we're talking about today. We're talking about something different. A self-directed IRA is a term of art in the industry, and it refers to not just one that you manage yourself, but one that is held by a custodian and where you're allowed to make alternative investments like real estate and direct investments in startups and other angel investments. Okay, let me lay some groundwork for this conversation. As we talk about investing via a self-directed IRA, I think it's really important to recognize that this is the kind of thing our wealthy friends do, right? Our genuinely wealthy friends, our friends that have net worth that has, multiple millions of dollars, 2, 3, 5, 10. Yeah, they all have these things set up. And of course, they'll think that this is the way you do it. And if you are in that boat, this is the way you do it. But if you don't have a $2 million net worth and $1 million investment portfolio, I want you to pause before you pull the trigger, because it can be expensive, and the expenses of the structure and the risks of operating the structure can overwhelm the benefits. There's really a narrow range of where this works well, and it requires some money. Now, a lot of ordinary investors, right? A lot of people who have regular jobs, teachers and nurses and certainly more affluent positions, but think of the doctors and lawyers. A lot of you who are in those professions and are arriving in your 40s and 50s, if you've been doing this work for a long time, you may look at your 401k and see hundreds of thousands of dollars in there. So you may not feel wealthy, but your IRA your 401k is really starting to amount to something. And under certain circumstances, that 401k, you can take money out of it and use that, especially when you leave a job. So if you change jobs, sometimes they'll give you the option to roll over your 401k into your new 401k, but you also have the option to roll the 401k into an IRA. And that IRA setup can be really powerful. Okay. This can make real sense. Don't be discouraged, but let's walk through this so that you're not getting taken advantage of along the way. So first off, we need to refresh our recollection a little bit. When we talk about traditional IRAs versus Roth IRAs, we're really talking about how the tax deferral or tax implications happen. And these apply equally to 401ks, 403bs, IRAs, and self-directed IRAs. So you can have a traditional 401k, a traditional IRA, and a traditional self-directed IRA. Traditional is a word in this context that refers to how it's taxed. With a traditional IRA, you get a tax deduction when you contribute to the account, and you defer taxes on that until you retire and start taking the money out. And once you're past 70, you'll be required to take a little bit out, or 70 or 72. But as you get well into retirement age, you're required to take some of it because the IRS wants to tax you. Quite frankly, that's why, right? You're required to take some money out. If you set up a Roth IRA, you get no tax deduction when you contribute, but that money earns interest, appreciates, and you never pay any tax on it at all. So that can be advantageous, especially for people who will have substantial assets accumulated and will be taxed at the highest rates in retirement. Because if you have income that can come from your Roth IRA and it doesn't count, it's not taxed, that can be really helpful if you'd otherwise be in that highest bracket. If you're in the lower brackets, it's not as big a deal. You might much prefer to have the tax deduction in the year you earn the money when you might even have higher income. So let's keep going. But let's try again to define what a self-directed IRA is. A self-directed IRA is customarily held by what is known as a custodian. That is not your broker-dealer. In fact, a broker-dealer, I've never seen one that can do this. They may have an affiliate that can do it, but a broker-dealer cannot allow you to do this particular kind of self-directed IRA. It's a custodian that can. And there, in that self-directed IRA, you can make investments that you can't make in a traditional IRA. So you could buy a duplex. You could buy a limited partnership interest that isn't traded on a stock market. You could buy shares in a company on WeFunder. You could make a loan to a small business via SMBX or Honeycomb Credit. You could invest in a solar project via Climatize. You could invest in a company selling shares, preferred shares on Start Engine or via Dealmaker. In other words, it opens up a whole range of opportunities for you to make these direct strategic investments known as alternative investments, sometimes more broadly, in ways that you simply cannot with an IRA held by your broker dealer, the regular kind. Now, it's really important to choose your custodian wisely. These tend to be smaller businesses. They are not typically genuinely large companies like Merrill Lynch and Charles Schwab. They are typically small businesses with tens of employees or maybe hundreds of employees, not thousands. The biggest maybe have hundreds. They tend to be small businesses. And so there is some significant variation in what they will allow you to do and the fees they charge. So you've really got to invest time and energy in choosing. And let me share a couple of stories that will help you understand why. I've had self-directed IRAs over the years. I'll share two stories with my self-directed IRAs. The first one, I set up the self-directed IRA at the behest of a friend who encouraged me to do this so that I could invest in a very early iteration of what would be an investment crowdfunding program. It was before the Jobs Act passed. So we're talking about 2007, 2008 when we set this up. Just going into the Great Recession. It didn't turn out to be a very fortuitous time to be investing this way. But I put some money in there. And while that money was sitting there, I didn't put a lot in, but a relatively small amount. And the fees were pretty modest, pretty modest. It was a local firm that operated, just literally down the street from where I lived. So I didn't know the people who ran it, but I could have gotten to know them because they lived right in my community. The CEO, it turns out, was stealing the money on an ongoing basis. He was taking money from the clients. Of course, he would report that he hadn't done that. So our accounts showed all the money was there, but in fact, when people started showing up to take it out, some of it was gone. In the end, he had taken about 10% of the money from the people whose accounts he was holding. It turns out, in retrospect, that's how he could offer such low fees. He was stealing money instead of charging us fees. So here's the punchline. That was my good self-directed IRA experience. I got 90% of my money back out. The SEC took custody of that money and assigned me to a new self-directed IRA account, a holder. And that experience was disastrous. They charged very high fees. And I ended up paying more in fees than I had lost to the other company. They wanted to charge me fees for printed access to my account statements and a different fee to have online access to my account statements, plus big annual fees, hundreds of dollars. I think I was paying $400 a year in annual fees for these accounts. And of course, if I did any transactions, that required more fees. And closing the account resulted in hundreds of dollars of fees. And after I closed the account, took all the money out. They reopened the account and started charging me more fees, even though there was no money. And I have to admit, to this day, I've not paid those fees. And periodically, I still get calls from them demanding that I pay fees on the account they reopened for me without my permission because they say they continue to hold an asset, which they do not hold. Okay, so let me be very clear. This is a place where there is, above everything else, a smorgasbord of fees. And so you have to shop precisely and carefully so that you end up with a fee structure that fits the kind of investments you will actually make, because they will all charge you substantial fees for closing the account or transferring the account to another self-directed IRA. And you don't want to have to pay those fees. But it's not unusual to pay a fee on every deposit that you make into the account and on every withdrawal that you make, et cetera, et cetera. And so if you're going to pay $50 to put money in and $50 to take money out, or $100 to take some money out, you want to be moving substantial amounts of money. You don't want to do that with $500. That would be 10% if you're paying $50. You want to do that with $20,000, $50,000. So this changes the game, right? We're not talking about how do you set up an account to manage $20,000 of your retirement assets. We're really talking about how do you set up an account to manage $100,000, $200,000, $300,000 of your retirement assets. Okay. So as you talk to potential custodians, you want to try and get a fee chart from them that would show all of their fees. And I've obtained, it's difficult to get these on their websites. I found a few on the websites of IRA custodians. And when you can find one, the list of fees, oh my gosh, it's brain breaking, right? Because they have a fee for everything. And the reason is broker dealers have a variety of ways of making money with your money. So the mere fact that you are giving them money to hold on your behalf and you trade it a little bit, even though they don't charge a commission customarily in lots of circumstances now, they still are making money on your account. A custodian cannot make money in any of those ways. The only way they make money is to charge you fees, and they have to stay in business. So they're going to charge you a lot of fees. So make sure you carefully screen for all the different ways they're going to charge you a fee, and make sure that you are contemplating that. And here's one of the key things that I worry about most. If you're investing retirement assets, you want to invest for income. We'll talk more about this. But if you invest in an SMBX loan, let's say you put $5,000 into an SMBX loan. They have a minimum investment of $10. But let's say you put $5,000 out of your self-directed IRA. So every month you're going to get a check for about $150 from that company that you invested in as a loan payment. Well, as you get those loan payments for $150 or $200 and you deposit that, if you have to pay a fee to deposit those funds that's meaningful, if that's $50 out of $150, your returns are shot to heck. You cannot make money with that kind of a setup. So you've got to be really careful. And if you're investing in pure equity deals, we'll talk about this, that may not be the wisest way to set up your retirement account. We'll talk about why in a minute. So check all those fees. That's the main thing. here's some red flags. If you cannot get them to give you that sheet showing all of the fees that you will ever be charged and explaining the fee structure to you so that you know exactly, like, if you make an investment and that investment delivers a return, is there a fee to account for the deposit on that? You've got to know that. And it's one thing if you invest $5,000 in a deal and 10 years later it becomes 50,000 or 500,000 and you have to pay a $50 fee. No big deal. But if you're getting those payments every month and you're paying a $50 fee on it, that's a big deal. So you've got to find out. If they won't talk to you about this, big red flag. So be sure to move on quickly. Do not set up a self-directed IRA with anyone who won't disclose the fees entirely, transparently up front. Crowdfunding compatibility is an issue. There is one self-directed IRA company. I'm not going to name names, but they advertise their compatibility with crowdfunding, and they advertise themselves to investors in that space as being sort of a crowdfunding friendly self-directed IRA custodian. Here's the reality. They're friendly if you happen to have an interest in investing in 2 or 3 different portals. There are 78 registered portals. If you're like me and you're portal agnostic and investing across the board in all these different places, that would not be a good it would not be a good custodian for you. Wouldn't be a good custodian for me. So you've got to be really careful, because they'll say they're friendly to crowdfunding, but they're really not. They're friendly to WeFunder and a few others. So be very careful about companies that make those representations. Dig deep. Make sure you know the answers to the questions. Now I want to talk about this equity investing side of things, because this is really an important concept. And I had completely missed this in my first 20 years of investing. And that was a long time ago now. But the reality is it's easy to get distracted almost by the fact that there is an opportunity to defer all the taxes until you retire. And, when you're 22, that really is important. There's no question. You are very unlikely to make an investment when you're 22 and hold it without ever getting a dividend and then selling it when you're 65. That's just not how it's likely to work. But as you get into your 40s and then certainly into your 50s and then 60s, wait a minute. I'm not sure it makes sense to put your equity investments in an IRA at all. Let me explain why. And this is true of stock market investing as well as with direct investments in startups and other companies that you can invest in on portals like WeFunder. So let me explain. So if you put $100 in a WeFunder deal in 2025, right now, you do it today, that business is going to grow. And you might make that investment in a very early stage business. And so it might be 10 years before that company gets sold or has an IPO or other liquidity event, and you are cashed out. And so you just wait. You just sit. There are no dividends. There are no checks along the way. There's no cash to be taxed, and you don't pay any tax. That company might grow tenfold, might grow 100-fold. It could grow 1,000-fold. And you know what? You know how much tax you pay? 0. along the way. It can appreciate and appreciate and appreciate. You pay no tax. Okay. Someday you sell that stock. Let's say that $100 investment becomes $1,000. Well, at the end of that decade, you will pay tax and on a long-term capital gains basis. And not on the 1,000, you'll pay the tax on the gain, which is $900. So keep in mind that that is a lower tax rate. Now, there was a decade of my life, thanks to President George Herbert Walker Bush and the Congress in place at that time, there was a decade where there were no capital gains discounts. Capital gains income was taxed as ordinary income for about a decade. But that ended with under the presidency of George W. Bush, and that was repealed, and we went back to having lower capital gains rates, and we have had them ever since. So let me show you. The highest ordinary income tax rate for those who make the most money is about 37%. Now you have to make, I think, over $400,000 a year as an individual to pay that rate. So you've got to be really rich to pay that rate. But those folks pay only a 20% tax on capital gains. So if you were in that bracket and you were paying that tax on your capital gain after 10 years, and you were paying that tax on $900, you would pay $180 of tax. If you were paying ordinary income on a $1,000 withdrawal from your IRA, you would pay $370 of tax. So you would pay more than twice as much, because you would pay not only on the gain, but on all the money you take out. So if you took that $1,000 out, because you're now in retirement, you'd pay that tax in a traditional IRA. If you are in a more ordinary income tax bracket, your tax would only be 15% on the 900. So your tax would only be $145. And if you are in a lower tax bracket in retirement, the lowest capital gains tax rate is 0. So if you are in the tax bracket where you're only paying 10% of your income, and there are a lot of ordinary income earning people who are only paying that 10% tax rate and get the 0% capital gains tax benefit. Think about that. So if you are not rich, you may not be paying much tax, and you certainly won't pay any tax during those appreciation years. So you're deferring a lot of your tax bill without using an IRA. So if you are into investing purely in equities, you are already deferring the tax. I'm not sure you want to be making those investments maybe in your 40s in an IRA, maybe not. In your 50s, I don't know. In your 60s, of course not. Of course not. I think you want to make those equity investments outside of your IRA and make income investments in your IRA. Invest in bonds and preferred stocks that pay dividends and other things that are, dividend paying loans. Put those assets in your IRAs where you can accumulate. That's the way I think about it. Again, talk to your tax advisor. Your tax advisor will know your situation better and know what's appropriate for you. So there really is not much advantage on equities. Now, if you're going to do debt, completely different, right? If you are going to get a check every month with interest payments, boy, on a lot of money, right? If you've got $100,000 invested in a portfolio of small business loans that earn an average of 10 or 12%, you'd be getting $10,000 or $12,000 a year in interest income. Boy, that would be kind of nice to shelter that from tax and have that money accumulating in an IRA where that could grow tax deferred or tax free if it's a Roth. So be thoughtful about that. Now, if you have a pretty modest income and you're equity investing, you probably don't need an IRA. You've got that inherent deferral. If you are, when you take that money out of an IRA, you're paying the full tax on as if it were ordinary income. So you could be actually increasing your tax bill in some circumstances. So be really careful. Okay. Again, if you are investing with an income approach, and I love this, I really do. I think this is a lower risk investment strategy. But as you start to do this and it starts generating income that is substantial, if you're doing it outside of your IRA, this is going to be taxable income. So that's why if you have the wherewithal to put this in a self-directed IRA, and you can find a self-directed IRA custodian whose fees are small enough when those dividend checks, those loan payment checks come back to you, I think you could really benefit from having a self-directed IRA. Imagine that you've got $100,000 invested. You get that $10,000 of income every year. If your ordinary tax rate is 28 or 37%, if you've got a state like California or Utah that's taxing that adds on to that, you could end up easily paying 40% of your income to tax. Boy, it would be nice to have that deferred so that you could accumulate those assets without paying tax, even if it's only for a portion of your assets and a portion of your life. Maybe you've already accumulated a bunch of IRA assets because you've been your mid-career or late career. Retirement may be looming. But this is a way to, I think, increase your returns and protect them from tax if you use the self-directed IRA. So let's talk about that. It really does make sense if you have a substantial IRA already and you want to allocate a substantial, let's call it at least six figures. Because if you can't make investments of at least $5,000 with your IRA, I think I haven't found a custodian where that works economically. You want to be investing at least $5,000 in the deals. And quite frankly, it would make much more sense for someone with $250,000 in a self-directed IRA investing $15,000 or $20,000 in each and every deal and building a strategic portfolio that way than with $100,000. But with $100,000, you could do it. If you're passionate about making these impact investments, you just can't have this kind of impact any other way. And your fees, your tax savings could offset the fees with $100,000. And a lot of us hold the bulk of our investment assets. The ordinary group of people, right? We might own a home or have equity in a home, might own a car, And then we got our IRAs. Those are our big assets oftentimes for a lot of sort of ordinary folk like you and me, right? So if you're in that boat, exploring whether to do a self-directed IRA could make a lot of sense. If you've got, hundreds of thousands of dollars in your IRAs and you're thinking about maybe I could move some of those into a self-directed, that may make sense for you. You certainly don't want to be doing a big lump withdrawal, right? Think about that. If you had $250,000 you wanted to invest this way, keep in mind that you would pay a substantial penalty on top of the tax. So you would not only pay the fee, the taxes, but also a penalty. So let's say you wanted to withdraw $250,000 because you didn't want to do the hassle of a self-directed IRA. Well, you might easily end up paying more than 40% of that in tax. Can you imagine? So your $250,000 would end up being only about 150 grand because of the tax. So that's not the right strategy. That's not the right strategy. Now, it may make sense for you to slowly build a portfolio if you have an event that would allow you to have a low income year, right? So if something causes you to have a big loss, there may be an opportunity. Talk to a tax advisor, financial advisor about that. If you've got a big loss, if you spent a year without taxable earned income, in that year, it may make sense to withdraw some assets that you could invest in direct investments, alternative investments, without that being in an IRA, and the tax penalty might be affordable to you. Explore that. But you certainly don't want to think, well, I want to be investing in WeFunder deals. I'm going to take $250,000 out and invest it. Damn the torpedoes. We'll just pay the taxes. So that would be devastating to your portfolio. So there is one path that is particularly intriguing to me. And this may make sense for those of you who have substantial sophistication, substantial assets, and if you wanted to invest something less than $100,000, but at least tens of thousands of dollars in these kinds of investments, you can set up what is called a checkbook IRA or checkbook control IRA. The way these work, and I have not done it, but the way I understand these work is you still have to have a custodian hold these assets, but instead of having ongoing fees, you might pay a fairly modest annual fee to have the custodian of record allow you to set up an LLC. You'd still have to pay all of the fees to have that LLC exist. And in California, it's going to be a franchise tax of at least $800. Can't avoid that. So there are fees that are substantial. If you're in other places, though, other states where those fees on having, the excise tax on an LLC is small or zero, this can really make sense for you to set up an LLC that would own the retirement assets. You move out of the custodian's accounts into your own accounts and you manage them entirely yourself. Truly, in the deepest sense, self-directed. Now, there's a huge risk here, and let's talk about the risk of the checkbook control IRA. you are now, in effect, your own custodian. You are now responsible for all of the compliance. Who are you going to ask, right? And it is complicated. The filings that you have to make, complicated. The all the things can be really, really complicated. And it's tempting to cheat. Let me give you some, like one of the rules would suggest that if you owned a second home and put that in your, or let's say an investment property, a vacation rental property, an Airbnb kind of property. So you buy this house in Lake Tahoe in Nevada. You think, oh, that'll be great. I'll buy this condo or this cabin or this house in Lake Tahoe, and I'll put that in my self-directed IRA. I've got a lot of money in there. I'll put it in. I'll use it to buy that. Well, one of the prohibitions, you can now not stay in that place. You can never use your vacation rental property. You can rent it and earn income, but you can never stay in it. And you have to be careful even to put money in an entity that you manage, right? So, like if I had a self-directed IRA, I could not invest that money in my business, the SuperCrowd Inc., right? That business. No, that would not be allowed. So there are all kinds of things that are tempting to do with your IRA assets that you cannot do. And so you not only have to comply, but you have to make sure that you are complying even when it's hard not to comply. So you really have to be careful. But if you are living in a state where there are low fees on an LLC, and you are an attorney or someone who happens to be handy with understanding these regs, and like maybe you were a stockbroker earlier in your career, and maybe all of this stuff is familiar to you. Maybe you've been an angel investor for a long time and you get all of this. This is okay. You may benefit from setting up a checkbook LLC and managing your own money and dealing with all of the compliance, or paying someone to help you deal with that compliance. So you've got lots of options. So as we wrap up, let's just make a note that sometimes this complexity just doesn't justify itself. A lot of us don't have $100,000 or $250,000 to allocate to our alternative investment strategy. And if you don't, that's okay. One of the great realities is if you're going to allocate $10,000 or $20,000, even if you invested all of that money for the benefit of income in your IRAs, the reality is what you would be paying in taxes would be pretty modest. So let's say that you had a $20,000 investment portfolio that you build up over 5 years by putting in $100 or $200 a month out of your income into these kinds of assets, especially income earning ones, just for sake of a discussion, right? So if you had a $20,000 portfolio earning 12% interest in a good year and no losses, okay, so you had $2,400 of taxable income. Let's say your tax rate is 24%. So you pay 24% of $2,400, which would be just under $600. Relative to your tax bill for the year, that's pretty small. Maybe you just say, I'm going to suck it up and pay the $600. That's cheaper than all the fees and less hassle. I don't want to break the bank and break my mind figuring out how to avoid tax when the tax I'm avoiding is so small. So yeah, you can build an income generating portfolio that can be a meaningful part of your retirement income, but just one of the strategies is to leave it out of your IRAs. Just have that be taxable income. If it's a fairly modest source of income, you're all good. So I encourage you to contemplate this, to think about this, and feel free to just keep investing your ordinary earned income in income that isn't protected in an IRA. Sometimes that's just great, especially if you find the appeal of investing is in the equity investments, because the tax deferral is sort of built in to those structures. Okay, I haven't seen any questions come in, but let me remind you that we have our VIP session starting in about 5 minutes. We'll wrap this up here in a few minutes, but we will begin. This is going to be the private session is conducted via Zoom. You can register right now. If you register, you'll get the instructions for joining the Zoom. We'll be thrilled to have you. You can do it right now. Visit 4sc.fund/VIPNOV. That's 4sc.fund/VIPNOV. That's the link on the screen there at the bottom. And we would love to have you, give you an opportunity to ask questions. I'll be happy to answer questions about your situation. It may be unique, and you'll come away with a better education, ready to talk more knowledgeably with your financial advisor. So I invite you to join us. We'll see you in a few minutes. Thank you so much for being here with us today. I am really grateful that you would make the time to spend with us. This is such an interesting work that we're doing, investing via crowdfunding. It's a fun way to make money, and it's a great way to change the world, right? When you support entrepreneurs who are doing things you want to see in the world, wow, you make a difference. You really make a difference, and it can really be profitable. So I encourage you to check it out. Join us for the VIP discussion. I hope to see you there, and we'll see you next month. We'll be doing this again in December. We do it every month on the third Wednesday of the month at noon Eastern, 9 Pacific. Thanks so much.